Everyone, and thanks for joining my YouTube channel. Today in episode 8, we will be discussing about the financial decision making. What if I told you a company can be profitable and still destroy value? That's not theory, that's most companies. Today, you're going to see why. This is not a finance lesson, this is how boards actually decide. Every number you see today ends with one sentence, and therefore the board should. If it doesn't, it is not decision making. WACC, NPV, capital allocation, these are not calculations. These are weapons. And by the end of this, you will see exactly where this company is quite destroying the value. Here is the number that decides everything, 12.6%. This is not just a percentage, this is the cost of survival. For every single dollar invested, the company must return $1.126 just to stand still. So here is the trap. A project can make profit and still destroy the value. 10% return looks fine, looks good, but fails the test. Value destroyed. So now ask yourself, how many successful projects are actually failing this silently? This is the shift. Profit is accounting, value is economic. Now let's build that 12.6% and see where it really comes from. This number is not random, it is built step by step. Cost of equity 3% risk free, beta 2.3, market premium 6%. And that gives you 16.8%, and that's expensive. Why? Because the investors think this business is risky. Now debt 8% before tax, 6.1% after. Debt is cheaper always, but too much of it creates always a different problem. Let's look at a capital structure, 60% equity, 40% debt. If you blend it all, you land at 12.6%. And this is a number that approves or kills every single investment. Now let's test a real decision here. NPV decision. $15 million. That's a decision, medical market entry. Year one, nothing, no revenue, just waiting. And this is where most people panic. No return, cash going out. Then growth kicks in year two, year three, year four, and NPV turns positive. And that's the moment that matters, right? This is not about profit, this is about the value creation. But here's a real risk, delay. If approval slips by just 1 year, NPV may drop by 25 to 30% itself. So the answer is not approve the project, the answer is approve it with controls, stage gates. Now let's hit the real problem, that's cash. 432 million dividend, revenue declining. Does that feel safe or dangerous? Free cash flow, roughly 500 million. Dividend takes 432 billion. That leaves almost nothing. No investment, no flexibility, no margin for error. So here's the truth, the dividend is not the problem, the combination is. The dividend plus the strategy that breaks the system itself. And I will call it as a trilemma. Like we call it dilemma, it's a trilemma. Now the real game, three choices, one pool of cash, dividend, R&D, medical investment, and you cannot fund all of those three. So what would you do? What do you do? Cut the dividend from 432 million to 350 million and free up about 82 million, and then fund the growth and no debt required, no further debt required. But this only works if you communicate it and market punish confusion and not the strategy. Most people make, they think finance gives answers. It's usually not. It gives the evidence. WACC is not interesting unless it drives a decision. NPV is not interesting unless it is validating some sort of strategy. Now we turn this into action, and that action is decisions. 3 decisions. That's what the board actually does. 1. Reallocate the capital. 2. Apply the WACC discipline. And the 3. Reduce gearing. Simple, right? Easy? No, not easy. Because every decision has some consequences. Real pressure. A board member says, don't cut the dividend, share price will collapse. What would you do? Option A, agree because it's safe, but it's wrong. Option B, disagree. This is leadership, right? Option C, compromise and you feel good, usually insufficient. Markets don't punish bad news, they punish the unclear decisions, and market price will go down if you do not communicate proper. So that means decision should be informed and market will not move that adversely you think. The CFO's job is not to be liked, it is to be right. This is where most people lose marks in the examination. They calculate, they stop. That's only 40%. The top answer always interprets, decides, and recommends. Every answer must end with, therefore, the board should. 3 takeaways. WACC is your filter. NPV validates strategy. Capital allocation is the real decision. You don't get to avoid trade-offs. You get paid to make them. Episode, we stress test everything because strategy without risk is just a storytelling. Till then, goodbye, and I'll see you in the next.